Part 1. Global Liquidity, the foundation of market cycles. Global liquidity is one of the most powerful yet misunderstood forces in financial markets. It is invisible, but it determines whether markets expand or contract, whether investors seek risk or flee to safety. While most retail participants react to headlines and short-term price movements, institutions focus on liquidity. Understanding this dynamic provides a long-term strategic advantage. Liquidity refers to money that is readily available to be invested. It includes cash, credit, and financial conditions shaped by central banks and global capital flows. Central banks influence liquidity primarily through interest rate policy, quantitative easing, quantitative tightening, and balance sheet management. When liquidity is abundant, financial conditions ease and risk assets tend to rise. When liquidity tightens, markets become fragile and risk assets struggle. Market behavior is not driven solely by news events. Instead, headlines often act as catalysts for moves that liquidity conditions have already set in motion. This is why markets sometimes rally on bad news or fall on good news. Liquidity is the underlying force, while headlines are often the surface-level narrative. Risk-on and risk-off environments emerge directly from liquidity conditions. In a risk-on phase, liquidity expands. Borrowing becomes cheaper. Leverage increases and capital flows toward higher risk assets such as equities, cryptocurrencies, and growth-oriented investments. Investors are willing to accept more risk because capital is plentiful and financial conditions are supportive. In contrast, risk-off phases develop when liquidity contracts. Interest rates rise, credit tightens, and capital becomes more expensive. In these environments, investors reduce exposure to volatile assets and seek safety in cash, government bonds, and defensive instruments. This shift is not emotional at the institutional level. It is structural and driven by changing liquidity conditions. Institutions understand that liquidity moves in cycles. They do not chase price, they anticipate shifts in financial conditions. When liquidity is scarce and sentiment is pessimistic, institutions quietly accumulate positions. When liquidity peaks and optimism is widespread, they reduce exposure and distribute risk. Retail investors, reacting late to price movements and headlines, often enter near-cycle peaks and exit during downturns. Historical patterns demonstrate the power of liquidity cycles. Before major market expansions, liquidity conditions typically improve. Before major drawdowns, liquidity tightens. These patterns repeat across asset classes and decades. While the specific narratives change, the underlying mechanics remain consistent. Understanding global liquidity shifts the investor's mindset. Instead of asking, "What will price do tomorrow?" the more relevant question becomes, "What phase of the liquidity cycle are we in?" This perspective reduces emotional decision-making and aligns investment behavior with structural forces rather than short-term noise. This foundation is essential before analyzing specific markets such as equities or cryptocurrencies. Without understanding liquidity, price movements appear random. With it, market behavior becomes more coherent and predictable within a broader cycle framework. Part 2. Risk on, risk off, and institutional positioning. Risk on and risk off dynamics are direct expressions of global liquidity conditions. These phases define how capital flows across markets and determine which assets outperform or underperform during different stages of the cycle. Understanding this relationship is critical for interpreting institutional behavior. During risk-on phases, liquidity expands across the financial system. Central banks may lower interest rates, inject capital, or signal accommodative policy. Credit spreads narrow, volatility declines, and investors feel confident deploying capital into higher-risk assets. This environment encourages speculation, leverage, and momentum-driven behavior. In risk-on conditions, institutions increase exposure to equities, high-yield credit, emerging markets, and cryptocurrencies. Growth assets outperform because capital is abundant and the cost of risk is perceived to be low. Importantly, institutions do not wait for confirmation in headlines. They position early, often before optimism becomes widespread. Risk-off phases emerge when liquidity tightens. Central banks raise rates, reduce balance sheets, or withdraw stimulus. Financial conditions deteriorate. Volatility rises and access to capital becomes restricted. In this environment, preserving capital becomes the priority rather than generating high returns. Institutions respond by rotating into defensive assets. Cash, government bonds, and low volatility instruments become attractive. Risk exposure is reduced systematically, not emotionally. This disciplined behavior contrasts sharply with retail reactions, which are often driven by fear after prices have already declined. One of the most important insights is that institutions operate ahead of visible market stress. By monitoring liquidity indicators, they adjust positioning before headlines confirm economic weakness. Retail investors, relying on news and social sentiment, typically react after significant moves have already occurred. This cycle of accumulation and distribution is consistent across markets. Institutions accumulate during low liquidity, low sentiment environments when assets are undervalued and risk is misunderstood. They distribute during peak liquidity when optimism is high and risk is underpriced. This process repeats over time, creating recognizable patterns for those who know what to observe. Understanding institutional positioning helps explain why markets often behave counterintuitively. Prices may rise despite negative news or fall despite positive developments. These movements reflect liquidity-driven positioning rather than narrative consistency. For individual investors, the lesson is not to mimic institutional trades directly, but to align with the broader liquidity cycle. By recognizing whether the market is in a risk-on or risk-off phase, investors can adjust exposure appropriately, reducing drawdowns and improving long-term outcomes. Risk-on and risk-off are not predictions, they are conditions. The goal is not to forecast exact tops or bottoms, but to understand the environment in which decisions are being made. This framework provides clarity in uncertain markets and replaces emotional reactions with structured analysis. Part 3. Liquidity, crypto cycles, and strategic application. Cryptocurrency markets are uniquely sensitive to global liquidity conditions. As high volatility, high beta assets, cryptocurrencies respond quickly to changes in financial conditions. This sensitivity makes them valuable indicators of broader liquidity cycles, but also increases risk for unprepared investors. Bitcoin often leads the crypto liquidity cycle. During early risk-on phases, capital flows first into Bitcoin as the most liquid and established crypto asset. As confidence increases, capital rotates into Ethereum and then into smaller altcoins. This rotation reflects increasing risk tolerance as liquidity expands. During risk-off phases, the process reverses. Altcoins, being the most speculative, typically decline first and most severely. Ethereum follows, and Bitcoin tends to be more resilient but still vulnerable as liquidity continues to tighten. This sequence is consistent across multiple market cycles. Understanding these rotations allows investors to manage exposure strategically. Instead of chasing outperforming assets late in the cycle, liquidity-aware investors focus on timing exposure according to market conditions. This reduces the likelihood of entering positions during periods of maximum risk. Key indicators help track liquidity trends. Central bank balance sheets provide insight into whether liquidity is expanding or contracting. Interest rate decisions influence the cost of capital. Bond yields and currency movements reveal stress or ease within the financial system. Together, these indicators form a comprehensive picture of global liquidity. Applying this framework requires discipline. The objective is not frequent trading, but strategic positioning. By aligning with liquidity trends, investors can participate during favorable conditions and protect capital during contractions. This approach emphasizes risk management over short-term performance. Focusing on liquidity also filters out noise. Headlines, social media narratives, and short-term price fluctuations become secondary. What matters is whether capital is entering or leaving the system. This perspective simplifies decision-making and promotes consistency. Over time, this method creates a repeatable process. Identify liquidity conditions, assess whether the environment is risk-on or risk-off, observe capital rotations, and adjust exposure accordingly. While no framework eliminates risk entirely, liquidity-based analysis provides a durable edge. In summary, global liquidity is the invisible force driving market cycles. By understanding how liquidity shapes risk-on and risk-off environments, observing institutional behavior, and applying these insights to crypto markets, investors can navigate volatility with greater confidence and clarity. Subscribe to MacroCycleLab for institutional-level insights into global liquidity, market cycles, and risk-on versus risk-off dynamics, so you can think in cycles, not headlines. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from MacroCycleLab. See you in the next video.